Did you know that all else being equal, mutual funds are inherently less tax efficient than ETFs or SMAs? An SMA is a portfolio of individual securities, so the investor isn't commingling their funds with anyone else's. ETFs and mutual funds are both investment clubs where there's a basket of securities and investors buy a share of the fund. They don't actually own the underlying securities, but the fund owns them, and the investors get exposure to the underlying securities by owning a share of the fund. But ETF and mutual funds are organized differently, such that when a shareholder is ready to sell out of a mutual fund, the fund manager has to process something called a redemption. When they process the redemption, if there's enough cash in the fund, then they can just send it out. It's no big deal. But if there's not enough cash in the fund manager has to raise cash by selling underlying securities within the fund. And when that happens, if there are capital gains resulting from that sale, all of the remaining shareholders of the fund must help the fund pay the capital gains taxes on that. So there is trading that occurs within a mutual fund, even a passive mutual fund, due to redemptions to help an investor get out of the fund. That doesn't necessarily further the investment objective of the fund, and it's not done because it's in the fund's best interest, but it's done to help get someone out of the club. And because of that, those capital gains go on a 1099. And so a lot of mutual fund investors get 1099s every year from their mutual funds, even though they never sold their own shares. They still have capital gains liability. Some of this capital gains liability is due to trading on behalf of the fund to further the investment objective. But there's also part of that capital gains liability that is just there to process redemptions. You don't have that in an ETF. Fund managers in an ETF don't have to pass off the capital gains when people sell shares of an ETF, just because they're set up completely differently. You will still get 1099 sometimes for an ETF, particularly an actively managed ETF, when the fund manager is making changes on behalf of the fund's investment objective. It even happens, though, sometimes in passive ETFs, because sometimes the index constituents change. The fund manager has to make trades inside that ETF. In an SMA, you only have capital gains when your portfolio manager trades on your behalf to further your personal investment objective. And so, obviously, ETFs and SMAs are just inherently going to be more tax efficient because the trading is always on behalf of the investment objective of the portfolio and not just to get somebody else out of the portfolio.